IPO window closing?
Looks like the IPO window is closing indeed. And as you know, that the IPO market is very fickle, goes up and down. It's been up for quite some time, and it looks like it is might be closing.
But why is it closing exactly? Because usually you tend to see these IPO windows close from extraneous factors, like a big stock market slump or an increase in volatility. It seems like this was caused by just an S1 for a risky company, or a company that was perceived by the market as risky, being disclosed, and all of a sudden everyone just kind of shied away from IPOs altogether. I mean, what's your assessment as to exactly what's going on here and why suddenly investors are turned off by these types of companies?
You know, if I knew, I'd be running a hedge fund, I think. You know, it happens. It happened in the dot-com boom. You had the crazy up through 2000, and then it just went down. I think part of it may be that you had the Vision Fund was, to some extent, pumping up valuations. They had, $100 billion. They were in Uber. They were in WeWork. And I think, it may just be some realization that maybe these companies are not worth what they were, and the market has gotten cautious. But it is always very volatile, and opens and closes, and sometimes you just don't know why.
Nicholas, are we starting to see a ripple effect in Silicon Valley because of this? I mean, how quickly does it get from IPO window shuts to VCs in Silicon Valley and elsewhere suddenly shunning some of these riskier, profitless startups in terms of investing in them?
It's a long lead time because the capital markets, I think VC looks at the stock market as a bit more fickle and a bit more volatile than the way they think about the world. So it's going to take some time for them to recalibrate the kind of companies they fund and how they value them in order to really reset the reality of what's happening in our markets versus theirs.
They don't take a public market mark right away if you're a private company that's in a similar sector and say, well, wait a second, we're nowhere near what we thought we were?
Yeah, no, not so much. No, and they've got their own way of looking at the world, valid or not valid. Their capital structures are very different from ours. They're much more complex. When you buy into a venture capital funded company, you're not just buying common stock. You're buying a preferred. You're buying somewhere in a tier. The cap structure is very different from ours.
Yeah. Steven, were you going to say something as well?
Yeah, I think it affects the later stage deals much more quickly than the early stage. So I think you'll see deals that, the Vision Fund might have been doing. Those valuations will come down.
And psychologically, Steven, how does it impact the minds of these investors? Because if they look at all of these examples of companies that haven't been able to get their IPOs done because they have certain characteristics, does that psychologically have maybe a quicker effect than actually, the later stage rounds that people are turning over cash?
I think what you'll see, and you saw this in the dot-com bust, that in the boom, people were buying growth. They weren't worried about profitability. And then at some point, something switches, and they all of a sudden care about profits. And that's what seems to be happening now. There's like an old phrase that I use with my students, that CIMITYM, which is cash is more important than your mother. And eventually, you need to make money. And it's just funny how sometimes the market lets you get away without making money. And then at some point, it says you need to make money. And I think we're at the point where it is moving toward you need to show us some profits.
Nick, yesterday, Morgan Stanley says that the We company's failure to go public is reminiscent of failed LBO of UAL, AOL Time Warner in 2000, JPM Bear Stearns in 08. Does it seem like it's going to mark an end in a secular trend?
It certainly feels like it marks an end in this sort of explosive growth of very large, late-funded companies coming public without much profits, without much of a profit story. That is over. Is it over for the market? Is it a top for the market? I don't think so. But I think we have to look at what this means for the longer term. We need companies like this to come public, create profits, and create value. Because over the last 5 years, you've had over $1 trillion of value created in just 5 companies. Google, Amazon, Facebook, we know the rest. This is how you create long-term value. And the fact that venture capital can't deliver companies that can then grow in public markets really puts a crimp in long-term returns. VC is the farm team for our market, and we need them to do their job properly in order to get our returns down the road.
So are you saying that they weren't doing their jobs properly then?
Absolutely not. I mean, if you look at WeWork, that was a categorical failure of governance, a failure of goals, a failure of a failure of management. So when you look at that, you think, if that were a public company, it would never have come. It's one reason to take a company public earlier, because you get the responsibility of our market, not the groupthink of venture capital.